colleague. Senator Warren.
Thank you, Mr. Chairman. So on Friday, the United States faced the second biggest bank failure in our entire history. And as panic spread among small businesses and nonprofits that had money deposited with Silicon Valley Bank, Treasury and other financial regulators announced they would take emergency measures to stabilize the system. I'm grateful for the administration's steady hand, but we shouldn't have had to be here in the first place. These bank failures were the direct result of policymakers' decisions over the last 5 years, beginning with a 2018 law signed by President Trump with the support of both parties to weaken the regulations that had been put in place after the 2008 financial crisis to ensure that big banks never again crashed our economy. On Monday, President Biden called on Congress and regulators to, quote, strengthen the rules for banks to make it less likely that this kind of bank failure will happen again, end quote. Secretary Yellen, thank you for being here today. Do you agree with the President that we need to strengthen our banking rules?
Well, I think we certainly need to analyze carefully what happened that triggered these bank failures and re-examine our rules and supervision and make sure that they're appropriate to address the risks that banks face.
Okay, so we want to make sure we've got the right rules in place. And pretty obvious we need some stronger rules here, so I want to talk about those rules, the stress test. Stress tests are critical tools in the regulatory toolbox that are designed to expose banks' vulnerabilities if bad things happen and force the banks to shore up any weak points before it's too late. Now, Secretary Yellen, when you were implementing the Dodd-Frank regulations as Fed chair 6 years ago, back in 2017, you said, quote, our stress testing regime is forcing banks to greatly improve their risk management and capital planning, end quote. But you warned that because, quote, we can never be confident that there won't be another financial crisis, it is important that we maintain the improvements that have been put in place that mitigate the risk and the potential damage, end quote. So I want to talk about those stress tests that you talked about, how important they were 6 years ago. Secretary Yellen, can regular, rigorous, well-designed stress tests help bank regulators spot problems lurking in banks' balance sheets and business models?
Yes, I continue to endorse the comments
Good.
you quoted. I think this has been one of the most important and consequential improvements in supervision since the financial crisis.
So, two thumbs up for stress tests. Let me just ask, when regulators spot these problems early on, can those regulators then require the banks to clean up the problems long before they trigger a run on the bank?
Yes, and in that sense, they're useful, but I would like to make one point,
Sure.
which is that the supervisory stress tests focus on capital
Yes.
and not on liquidity. And in these bank failures, liquidity played an important role.
So let's ask the question then all the way around. If stress tests are done right, if we have robust stress tests, the way you described 6 years ago when you were still running the Fed, do they just test one thing that might go wrong, or do they test for lots of different problems if they're done right?
If they're done right, they test for many possible problems, but they do not focus on liquidity.
Okay, but they test for many
capital.
kinds of things that go wrong. Is that right? Potentially.
Yes, there are different scenarios every year, and
so let me ask you then a related question. Is one of the problems that stress tests can expose is that you have managers who are not very good at managing risk, or management that is otherwise doing a bad job that could put a bank in jeopardy?
well, that's the purpose of supervision, and supervision, stress tests are one tool, supervision is another tool that's critical.
Okay, So,
focuses
very
on other
important.
things.
We've got stress tests, we've got supervision, we've got a lot of pieces here to make this work. In 2018, though, Trump's bank deregulation law and the door it opened for Fed Chair Powell to further hack away at the rules created an exception to annual Fed-administered stress tests, letting banks from $50 billion to $250 billion effectively off the hook. And that meant that a bank like SVB, which had $209 billion in assets when it failed, would be exempt from annual stress testing. So the question I have here is, if the law had not, let's not just do stress tests. It's stress test, it's the whole package. Enhanced liquidity requirements that ensure that banks have enough cash on hand to meet their obligations, particularly in times of stress, capital requirements that better position banks to absorb losses, regular resolution plans to help guide regulators safely through winding down failed banks. All of these were weakened in 2018, and when SVB failed, this is a part, in my view, of the Fed's actions that led to weaker regulation. You know, over the last few days, we've heard a lot of Republicans say that this collapse wasn't their fault. It was the banking regulators who were asleep at the wheel. And believe me, I have questions for a lot of the banking regulators. But Congress handed Chair Powell the flamethrower that he aimed at the banking rules. In fact, he said so himself. I'll quote and then I'll quit. When he announced that he was weakening regulations for the banks like SBV, Chair Powell said, and I quote, "In the rules before us, we are applying the discretion granted to us by the Economic Growth, Regulatory Relief, and Consumer Protection Act." Translation: Congress opened the door to weaker regulations, and I'm waltzing right through it. That's true. Congress needs to close that door. I'm sorry, Mr. Chair.
My colleague has great experience in this, and I apologize for having to cut people off. Senator Johnson's next.